Good afternoon, everyone. My name is Arthur. My thesis is about developing a credit risk model for corporate lending, as you have heard. So the contents are the following. I'll briefly introduce the problem that I've worked on for this period, then show how the literature review and the research gap supports my research, then showing the methodology, so how I structured my work to achieve my results. Afterwards, just show the results in the conclusion, and then show my final remarks, suggestion for future works, etc. So first point is about why this problem. Credit risk models are a very important tool for risk management for lenders, especially for regulated lenders after the Basel II Accord. And the most widespread technique is the logistic regression because regulators require interpretability, and this provides a lot of interpretability. At the same time, new fintech lenders, most unregulated, may explore other machine learning techniques. And especially in the SME world, where I develop my work, this is low default portfolio, so there's a huge class imbalance. So from the lenders I lend, only a few of them go defaulted. Then there is the sample bias. So if my rejection rate is about 60%, there is a huge sample bias because when I develop a new model, I develop in the accepts only, with the performance of the accepts only. And when I shift my model, I may have problems later on. So treating the sample bias would be a good thing since we could use the information in the rejects. And later, to select the most suitable technique. So recently, as I mentioned, fintechs are more unregulated. They can use more machine learning techniques. And why not taking profit of more advanced machine learning techniques that could give better results for the model? For example, better accuracy, etc. So in terms of the literature review, those performed in the Scopus and Web of Science, I took the latest, roughly the latest 10 years of articles to show the most recent advance. The keywords used were related to my topic, so basically everything I wanted to explore. And then at the end of the day, I ended up reviewing the text of 86 articles, but my starting point was almost more than 700 articles by direct search and backward citation. As you can see, when you draw a map with the keywords, you can see that machine learning is a very central point in the articles I researched, but you can see the other points I would like to discuss. For example, reject inference was one of the very important points, one of the keywords that showed up in all of these articles. So to summarize my literature review, I classified the 86 articles in three main points. One is the approach to the statistical of our machine learning techniques. So it's to understand if machine learning techniques or ensemble methods could outperform the traditional techniques, such as the logistic regression and decision trees. When we look at the whole literature, usually the machine learning techniques, they outperform the traditional methods. So this is a question that's barely answered in the literature. The other point is the approach to the unbalanced data. So which approaches can be explored? And extensively in the literature, we see most of the people using SMOTE, which is the synthetic minority oversample technique, even if they use other things. But one interesting point I noticed is you can use the statistical technique to approach this problem as well. So some authors use generalized extreme value, ensemble methods, neural networks. And the latest point is the approach to the reject inference. Is there any prevailing approach? And we see that 13 documents approach that with no prevailing approach. SVMs, so support vector machines, were widely used, but I thought it was more interesting, and it's more, I could explain better how I could use label spreading to solve my problem. So that was the whole idea behind it. In terms of methodology, I'll go very quickly here. We have a data set, a corporate data set with 1,500 anonymized cases from a company that lends digital SMEs. On this 1,500, 417 loans, 54 bad cases, or at least classified as bad. So it leads to a bad rate of about 13%. And I export 113 variables. These variables are related to balance sheet, P&L, bank account ratios. So I mixed all of these variables, created lots of ratios, and then these variables could be consumed by this model. In terms of statistical and machine learning algorithms, so I export two versions of logistic regression, one with lasso and ridge penalty. I won't go into too much details, but the penalties are different, the results may be different. And I prefer to use LightGBM. It was widely explored in the literature as well with good results. And this is a leaf-wise approach, so it guarantees the best split between the nodes, guaranteeing higher accuracy when we train a new model. In terms of the label spreading, so the label spreading assumes that nearby points are assumed to have the same label. So if a unknown point with an unlabeled point is surrounded by people classified as bad, or as they will be classified as bad, otherwise they will be classified as good. And it assumes also that the points in the overall same structure will have the same label. In terms of evaluation, I use two metrics very used in the industry. So one is the KS statistic, and another one is the area under the receiving operating curve. I assume you know very well this metric, so won't go into lots of details on it. In terms of the proposed setup, so as I mentioned, we have labeled cases, the 417, the unlabeled cases, and then basically we had the whole process to get to the final model. So the labeled cases, they are unbalanced. They were balanced via SMOTE. And then I separate a 30% holdout sample to test the results. Then the rest I put in the training sample. I use the label spreading to assign labels to unlabeled cases. And then I finally train the model with the two versions of the logistic regression and the LightGBM classifier. As you can see, just going through, I applied the smooth balance. So basically from 13%, I got to 42% bad rate in my final sample. And then I increased the sample by about 200 synthetic samples. Then the next step, applying the label spreading. So as you can see, the balanced data set, the bad rate was about 40%. The unlabeled data set got a bad rate of 60%. And that's expected because since these cases were rejected, I would expect them having a way higher bad rate than the balanced data set. One thing to point out here, I used a single parameter. So the number of neighbors in the KNN were 15. The alpha parameter that guarantees the smoothness of the label spreading, 0.7. So this is something could be more explored if I generate an automatic pipeline that tests these things more recurrently. But for the purpose of this thesis, I wanted to explore only one parameter and then to see what the results would be. So as it comes to the model training and evaluation, so I trained all three models. The model parameters, the hyperparameters, were calibrated via grid search. And as you can see, the REACH and the LightGBM model, they use all the features. Whereas the lasso logistic, their penalty allows to remove features from the model, not only to assign lower weights. So basically 50% of the features were dropped in the final model. When we look at the model AUC results, we can see that the lasso and the ridge logistic were very close to each other in terms of value. So when we compare train, test, and label dataset, the results are pretty close to each other. When we look at the LightGBM model, and then this is something interesting with the number of features, because if I wanted to implement a model, I would implement the lasso because of the simplicity. On the other hand, the LightGBM model yielded better results in terms of AUC and KS. But one thing to point out here is there is a huge difference between train and test. So this brings to the question, is there any overfitting into the model? Probably there is some because of this huge difference. But comparing between the different techniques, I would say the LightGBM outperforms because when we see the k-fold validation across the grid search, we saw that the AUC in the train model was always over 90% with an average of 96%. So one point is that there is some overfitting. We could refine that, but LightGBM still would outperform any these traditional techniques overall. Then a quick discussion about the model feature importance. So for the logistic regression model, we can use the regression coefficients as the feature importance. In the LightGBM, since it's a tree-based model, I need to use the SHAP values as to explain how important is a feature into the model. So all the models have shown intuitive features. So I used all the 113 because it's not the purpose to cover the feature selection, even though it's an important point. I just would like to compare the models overall. and the log odds and the sharp chart was consistent. But I would like to point out that there are some features that are counterintuitive, and some examples are the ones below. So in the last logistic, the short-term debt to assets, the higher it was, it led to a negative coefficient. So it's counterintuitive when we talk about experience in the industry. Same thing, for example, in the rich, the contribution margin, it had positive coefficients. And I would expect the coefficients to be negative. This is because of corporate experience. We know that companies that can generate higher margins are less likely to default. And same thing for LightGBM. So debt to contribution margin, giving a contribution to higher odds of being a good customer instead of bad customer. And for trade receivable days, also the opposite. So I would assign two reasons, even though I couldn't investigate a lot about these counterintuitive variables. One is the nature of the data set. This data set was very, very treated, anonymized, features are normalized, and a low number of bad cases. So we could be propagating a spurious relationship as we apply the different techniques across the pipeline. So when I apply SMOTE, I may be propagating something. When I apply label spreading, I may be propagating something. And then on the other end, the remaining multicollinearity, even when penalties are applied, it's a huge number of variables, lots of treatment. So this is something that could be better explored, the nature of the feature selection. So to summarize this whole research, credit risk models are very important for companies, especially for companies that all the lenders in the world. But it's important to improve the risk management capabilities of the financial institutions. So the better my models, better my risk management capabilities, especially when I'm regulated. However, in low default cases and in lending to SME, we have some challenges. So first one, most of the SME lending has low defaults, so it leads to higher class imbalance. Sample bias is present in almost all credit scoring problems. So we have the loan performance only for the accepts, and the industry standard is not to explore a lot machine learning because people want to have confidence, want to have explainability. And the later part is to choose the learning technique. So as we have unregulated lenders, as we have more modern machine learning techniques, why not to use them? So thinking about these three problems, the literature shows the machine learning techniques outperform. So when they can be used, it would be good to use. However, the three problems at once in 86 articles, they were explored in only one article. So this is interesting to join all the pieces together. Then the sample data set was used, so we can see that this funnel between the number of cases, then the number of loans. So the first piece with the sample bias, then the low default, about 12.3% bad rate, and we had 113 features. And then we designed this framework to apply the SMOTE to balance the data set, then to apply the label spreading to reject inference, and then to train the three models and to compare. When we see the LightGBM, as I mentioned, it outperformed the two versions of the logistic regression, but the dispersion of the results may show it's a little prone to overfit. However, even if we take this tendency to overfit when we do when we compare all the k-fold validation, we can see that all AUC values are over 90%. So when all features were used, there is this feature point, some counterintuitive contributions, and this may be due to the process, so spurious relationships being spread. So as I would suggest for the next steps is like to change the parameters to the pipeline, so search for a way to optimize the pipeline parameters and to refine the feature selection process. So thank you for that. I would like to thank Professor Afshin, my supervisor, also Professor Jorge Bravo and Professor Yasser for the possibility of evaluating this presentation.